Hi everyone, and welcome to our YouTube live session, and we'll be with you for an hour. And essentially my mind is open to you. You can ask any questions you like within reason. It's got to be to do with investment preferably, or physics. You could ask about physics or about my cockapoo Teddy, who I won't tell you what he was doing just now. It was quite disgusting, but here you are, you can have a treat anyway. Good. So if you do a super chat, we'll push you to the front of the queue. If you're one of our YouTube supporters, again, you'll be pushed to the front of the queue to have your answers, your question answered first. And then if we run out of those questions, we'll move to everybody else. So obviously it helps us if you do a super chat, because it means that it's obviously some revenue for us and make sure that we can keep going. And similarly, if you support us on YouTube, because it makes sure that we carry on creating content, which I assume you like if you're watching this YouTube live. So thank you all for joining us. We have got quite a lot of people asking questions already. And Laura will be chipping in as we go along. She'll say things like, subscribe, because you are going to help us obviously if you like this stream and if you subscribe to our channel. So she'll also be shouting out questions. So are there any Slack questions? Okay, so we'll start answering some of the questions on the list that I've got here in front of me. So the first question is from George, who's a UK expat and who has 2 years of NI contributions. That's national insurance. So in the UK, if you're not familiar with it, you get your own state pension, but you have to contribute to it during your working life in order to receive it when you retire. Is it better to make voluntary NI contributions around 700 a year, can pay for past tax years, or invest in an index fund? I'm 36. I think the deal's pretty good. I mean, I've spoken to people who've missed out on national insurance contributions during their life. And because it's inflation linked and currently still has a triple lock, so that's pretty good. It's probably worth making some, fill in the gaps if you do have gaps in your NI contributions. So that's what they told me anyway. I mean, I'm certainly no expert in NI, and I can't tell you whether that's optimal. But that doesn't mean you can't make contributions to your index investments as well. It really depends on how much you've got to invest. If I had a choice, personally, I'd probably go for the index funds. It really depends also on how long you've got until you retire. So if you're just starting out, then missing a few years isn't going to make a huge difference to your NI. You can always make that up later. And you can always check how many years of NI contributions you've got. That way you can make sure that if you are approaching retirement, you're going to fill in the gaps if you want to. So that's the way I'd probably do it. I'd go for the index first, then for the NI. But really, as I say, it depends on how long you'll be investing for. And if you're not going to be investing for that long, if you are close to retirement, you say you're 36, you're not close to retirement. But if you were, then I might think about just making up the NI before I retire. That way, at least you have the state pension, the full state pension, which is index linked. Right, next question. Interesting. Susie Truck says, for withholding tax on ETFs, is it true that the taxes are higher if the fund is in Luxembourg instead of Ireland, or is it the same? Thank you. I believe that is the case. It depends on two things. So if the asset, so let's say you buy a US equity ETF. I mean, most equity ETFs will have a big US allocation. A global one will, for example, because the US is so big. Then the withholding tax depends on where the assets are based. So in this case, it would be the US, and where the domicile of the fund is. So in this case, it would be Ireland or Luxembourg. Now, Ireland, I believe, has a 15% withholding tax compared, in its relationship with US investments. Whereas Luxembourg, I think, is higher. I think it's 20 or 30. So that's why it probably would be beneficial to have Ireland as the domicile rather than Luxembourg if it's a US asset. But really, those withholding taxes depend on where the assets are from. So if you are holding Asian assets, for example, the withholding tax rules would be different. So really, it depends on those two things. Now, if you go for a synthetic exchange-traded fund where there's actually an embedded derivative inside the ETF, you may not pay any withholding tax at all. That's because inside the fund, there's a derivative such that there's a counterparty, which is usually an investment bank, which will hold the assets on their own balance sheet in the country where the assets are based. So let's say it was Goldman Sachs as the counterparty for the synthetic ETF. In that case, Goldman wouldn't pay any withholding tax because from the point of view of the assets, it's Goldman that owns them. And then the derivative is just an agreement to pay the returns to the ETF creator. So that's why these synthetic ETFs are now becoming more popular, because if you're not paying a withholding tax, particularly for funds which have a high income, those can be very beneficial to have a synthetic version of the fund. And even BlackRock, which was very negative about synthetic ETFs, is now coming around to them because of this withholding tax issue. So it's an interesting point, Susie. But that's I think you're right. I think it is. If you are going to be paying withholding tax and it's US assets, then I think you're right, which is that Ireland's better. Next question. So Laura says there are some questions on Slack. Yes, here we go. Hisham, hello. Hisham Daoudi says, hey Ramin, why are you going for a 2-year period of drip feeding yourself and not a longer or shorter period? What will your personal stocks bonds allocation be after 2 years of drip feeding? Okay, so this is my main portfolio, which is my ISA with Vanguard, where most of my assets are. So what I'm doing is I'm very cautious. Now, I always tell people don't do what I do because you're not the same as me. You don't own a business. You're not the same age. You don't have the same business as I do. So really, it's not appropriate to copy other people's asset allocation. But people ask me, so I tell them. And so I've gone for a 2-year period because I'm very cautious. I think probably sometime over that 2-year period, we're going to see probably a tumble in equity markets. I don't really know if that's true. But if we do, I'll accelerate my purchases of equity. My target is 80% equity. So that'll be 80% equity, 20% bonds. And probably I'll just have one global bond fund, one global equity fund. The equity fund I've chosen is the FTSE Russell Global All Cap Fund from Vanguard, which is one of the UK ones in the UK, one of the funds available in the UK, because it's simple. It's an accumulation fund, so I don't have to think about reinvesting dividends, low maintenance because I'm lazy, and I wanted to keep my investments as simple as possible. Why am I doing it over 2 years? Because I think probably we will have a better entry point over that period. Why am I going for 80% equity? Because my own back tests have shown me that that's probably the best thing to do. Have a high equity allocation, even though equity is expensive in the US. So it doesn't usually pay to hold back money from markets because equity is expensive, because it can be expensive for a long period of time. And expensiveness is a very poor signal to sell. So all of this stuff you see in the press about all things are at all-time highs or the valuation measures are very high. The fact is, when you actually do back tests, selling when equity valuations are high based on CAPE, Shiller's CAPE ratio, or Shiller's new excess CAPE yield, which is what I used, doesn't work. It's best just to invest as quickly as you can, most of the time. So that's the plan, and that's where I am right now. But don't do what I do, because firstly, I don't know what's going to happen to markets, because nobody does. But I know that the back tests show me that I should have, the actual rational thing to do would have been to just pile everything into equity straight away. And in fact, I'd have been better off if I had done that. But, I've been investing gradually. I'm 5 payments into a 24-month drip feed. So I'm still not very heavily invested in equity. Mostly it's in bonds at the moment and cash. Frey, hello, how are you doing? Would your general investing advice, index investing, remain unaltered if you suddenly were blessed with a precognition of a so-called lost decade? Well, if all I knew was that we're going to have a lost decade, and I assume you're talking about equity market lost decade, so we're going to have a drawdown period of a 10-year drawdown period, would I still invest in indices? Probably not. No, I mean, if I knew that equity was going to sell off and that risk assets were not going to perform well, then clearly what I'd do is I'd pull my money out of equity. But it wouldn't make any difference as to whether it was in funds or not. I still wouldn't go for single stocks. I'd probably put it into fixed income. So I'd put it into long duration govies probably. But I mean, it would be useful to know whether we're going to have stagflation, because if that was the case, I wouldn't put it into long duration government bonds. I'd put it into short duration, or even keep it in cash, because obviously inflation has a bigger effect, negative effect, on long duration government bonds. But I would get a bigger jump from the long duration when equity markets fall. So really, I mean, that it would be nice if I had more information from the future, Frey. I mean, I wish you could provide that. But my advice, I guess, to myself would still be index investing. It's just the asset allocation that would vary. So there's a big difference between, should I use indices or not, and funds or not, or should I stock select? Because, that's a very different story. Asset allocation probably accounts for a lot of people's success or failure, whereas stock selection is unlikely to be a winner for most people, or even most investment professionals, as we know, if you look at the Spiva report from S&P. So that's why I think, index investing would still be what I do. I just invest in different indices. That's all. Talbot Sunbeamer, hello. I love Talbot Sunbeamer's sense of humour. He had some very good tweets making fun of the people who were spamming our comments on YouTube. So always a big fan of Talbot Sunbeamer. He says, "Good evening, Ramin. Hope you're well. Good video last Saturday. I summarised it as when times are hard, buy soup." Very good. What was the video last Saturday? I lose track.
Factor funds.
Factor funds, yes. Yeah, that was interesting actually, because I was surprised by the result. I actually found some data from MSCI on factors going all the way back to the late 80s. I think it was 1988. And what was really interesting was that quality and momentum do very well, and growth historically has not performed very well when you adjust for its risk. And the risk measure I used was the Ulcer Index. Unlike volatility, what the Ulcer Index measures is how long a factor or how long a stock or a fund goes beyond its previous all-time high. So how much it dips below the all-time high, previous all-time high, and how long it stays there. So the deeper it goes below its all-time high and the longer it stays there, the bigger the Ulcer Index, the more ulcers you get. Because we always tend to anchor based on the previous all-time record. Even if we're up 200%, we'll always think, oh, I'm down 50% since the previous peak. That's just our human nature. So that's why I use those measures to look at which factors were most palatable. Because I think it's one thing to prove that factors outperform long term. I think it's another thing to have factors which are tuned with our ability to stomach their risk. And it's just unrealistic to expect people to buy value now because it's been underperforming for almost 15 years. So that made it very difficult for people to stick with value. And I doubt many people who don't have to did stick with value through that 15-year period. So I think it was certainly interesting to see that quality and momentum were the two factors that didn't have too much Ulcer Index, but still performed very well and significantly above the MSCI US Index. And this was only for US equity, but that has more history, which is why I did it. But anyway, interesting video. I was interested by the result myself. So anyway, yeah, factor investing, that was our video from last week. I recommend it. It was quite fun to do. Next question is from Arsenio Penesi, who has the coolest name, sounds Roman. Arsenio says, "Hi Ramin, what have you learned so far from the VIX tracker you bought?" Yes. Would you recommend a 5% allocation to that kind of product as a sort of insurance against equity crash? Yeah, I wonder if I can show you that because it is interesting. Let me just pull up the portfolio and I'll just talk nonsense while I do that. So let me just pull up the fund and then that thing. Right, share my screen. Share screen. Picture in picture. Here we go. Right. So here we go. Here's my kind of fun portfolio where I put all of the toxic stuff that I buy. So all of my core portfolio is really boring. That's on Vanguard. But then I have another ISA. That's a kind of tax efficient savings account in the UK with Trading 212 where I put the toxic stuff, where I kind of experiment with stuff. So I've got a 3 times leveraged Wisdom Tree fund. I've got MicroStrategy, the company which has bought loads of Bitcoin and then issued a convertible bond to buy more Bitcoin. And this is the toxic one, right? So this is the VIX. So this is the VIX Enhanced Roll ETF, which I bought. The unfortunate ticker for it is got the word VOM in it, which kind of tells you all you need to know, because what this thing does is it buys futures on VIX. VIX is a fear index of volatility. Now, one really reliable hedge for equity is volatility. The difficulty is how you buy it, because it can be expensive to buy volatility. And if you're buying an ETF, usually the carry cost is negative. And that's because the futures curve is upward sloping. So you're continually selling the cheap end of the curve and buying the expensive part of the curve when it's upward sloping. So in finance, we call that a negative roll cost or negative carry. So what this fund does is kind of clever. It moves around on the futures curve and it buys the bits which aren't so steep, usually the ones further out on the curve. And that way it reduces the carry cost. Now, if we look at another one of these funds, so let's look up VXX. Now, this one doesn't adjust that way. So if we look at the value of this thing, sure, it spikes massively when there's an equity market crash. So in March last year, this thing went up a crazy amount. So if you'd have timed it perfectly, which no one ever would, you know, this thing went up, what, 400% over the space of 3 weeks. But look what happens to it long term. If you look at it long term, it just gradually decays all value away. And they have to constantly reissue these things because the value is always lost due to the roll cost of fixed futures. So that's why I've gone for LVOM, because it's kind of a little bit clever about the way it buys volatility, because it kind of optimizes the roll cost. But it still suffers a bit. So firstly, during a crisis, it gains less. So we saw VXX, which is short-term VIX futures, that gained 40%. Well, LVOM only gained 313 because it wasn't on the right part of the VIX term structure. Usually the short-term futures gain more than the long-term. So this thing is further out on the curve, so it's less sensitive to VIX. But also, what's good about it is it decays less. So you can see it had a fairly flat period here between 2018 and 2020 when vol was pretty low. But this one has been decaying. So it has decayed a bit since I bought it, but not a lot. So, would I recommend it? Probably not. I did some back tests and those were kind of interesting because what I showed was that if you look at the optimal allocation or trying to find dynamic rules for when to switch, more money into some of this insurance, based on valuation or based on volatility, there is no optimal threshold. So you're always better off just buying equity. And the actual hedge is probably not worth it because the roll cost, even for something like LVOM, is still too high. So why have I still got it? Maybe I'll sell it. But this is my kind of experimental portfolio. So I still have stuff in there which is toxic, like KWeb. I took a big hit on that, but I never invest too much in each of the funds which I put in there. It is my kind of experimental sandbox for investing. So no is the answer. So my kind of hedge is going to be cash and government bonds. Gary, hello. Good evening, Ramin. Could you please explain how global equity ETFs track the price according to their underlying assets? By the time Mexican markets open, Japan is closed. Not all stocks have ADRs. Ooh, good question. In fact, there is a period when ETFs, the price isn't perfectly defined. However, there are certain guides that the ETF managers can use. So firstly, what is it that keeps ETFs in line with the value of the stuff in the ETF? Well, that's a process called creation and redemption, where authorized market participants, these are usually brokers, will look at the value of the ETF, they'll look at the value of the stuff in the ETF, and they'll say, is there a difference? And if it looks like the stuff in the ETF is cheap and the ETF itself is expensive, then they'll destroy one of those ETF units and they'll buy the stuff in the ETF. And that way they can make a risk-free profit. But what that does is it brings the two prices into line. So it's this creation redemption process that makes sure that the value of the ETF matches the value of the index it's tracking. Now, in the case of markets being closed, you can use other instruments to track the market. So it could be you could use futures to track the market, and the futures market may be open for hours which the equity market isn't. So that will give the ETF participants, the ETF authorized participants, it'll give them a guide as to where the ETF should be trading. But you're right, there will be a period sometimes when markets open in a certain region, you'll see there is a blip in the price of the ETF as the authorized participants step in and arbitrage away any kind of difference between the value of the assets and the ETF. And there's a grey market, so some market participants can trade out of market hours, but and the authorized participants probably could. So that's why the plumbing still works even when markets are in theory closed. But you can still get a guide as to where markets should be trading roughly. So there will be mispricings, but they'll be very, very quickly arbitraged away as soon as markets open. Great question. I love that. Okay. Another question. Oh, thank you, Alessandro Bergamo, who's done a super chat. Really appreciate that. He says, thank you for the great content. Thank you for the content. Keep up the good work. Thank you, Alessandro. And Kieran Walsh, very kindly, also super chatted us and asked a question. Oh, I've woken up Teddy. The dog is stirring. It's a bit like having Smaug the dragon when he smells these treats.
We have a like in the show.
Oh, yes. Laura says, Laura says like the stream because it helps us. Even if you're watching in replay, please do like. That's right, isn't it, Ted? Because that pays for kibble and treats, doesn't it? Yeah. And also subscribe if you haven't already, so that you'll see our content in future. I guarantee we do our best to make it interesting. You're trying to sniff on the desk to eat the rest of the treats. That's very naughty. It's a good thing I like you. Next question from Kieran, who did the super chat. Thank you, Kieran. He says, is the reverse repo market, which is now over $1 trillion, a signal that there's too much money supply chasing too few treasuries, or related to debt ceiling? Yeah, I mean, I did a video about this, and reverse repo, if you're not familiar with it, let me just pull up the slides for that video, actually. That could be kind of interesting. Reverse repo. It's amazing. I've got a whole repository of these slides, which are quite useful as a kind of reference for me as well, to see what I've done in the past. But let me just pull up the reverse repo slides, and then I'll kind of share this with you. And this is something I didn't get to share in the video, which I was quite proud of. Let me just show you this. Yeah. So this is a slide that didn't make it, which I really liked. And this shows you the size of the Fed's balance sheet. So assets are the stuff the Fed owns. Liabilities is the stuff the Fed owes to other people. And reverse repo is on the liability side of the balance sheet. And at that point, it was 721 billion. Currently, it's over $1 trillion, according to Kieran. Obviously, things like Federal Reserve notes, so cash that that sits in American pockets is a liability of the Fed because it produces money, and deposits also. Those are commercial deposits, probably capital accounts as well. So these are the liabilities of the Fed. And then the assets are the securities it owns. So 7.8 trillion in securities at that point was the mortgage-backed securities it had bought and the US treasuries it had bought. And now we know that's over $8 trillion. But the reasons for this kind of issue was at least these are the reasons I found for the reverse repo market. So let me just quickly touch on what reverse repo is. Repo is when the Fed puts money into the banking system. So the Fed receives US treasuries from banks usually, or asset managers, and it gives them cash back. So it's injecting cash into the banking system, which can then be lent out. So that's injecting liquidity into the banking system. Reverse repo is the opposite. Now, that's kind of weird. You might be thinking, well, why would the Fed take money out of the banking system? In fact, that's not the choice. It's not the choice of the Fed to do that. It's a choice of the banks to get treasuries, because firstly, banks need treasuries, and the other group of people that need treasuries are fund managers, particularly money market funds, for example, because they invest in these assets. And there's actually a shortage of those assets at the moment. So if we look at, where is it? Yeah, if we look at the, where is it? Yes. So these are the issuance. So this is how the US government raises capital in the equity in the bond market. So these are the 2, 3, 5, 7, and 10-year US treasuries. So this is borrowing for the US government, Uncle Sam, over a 2 to 10-year period. And gradually you can see that issuance has been going up as they borrow more over those periods of time. Bills are less than 1 year in maturity. And what's kind of interesting is that when the pandemic kicked in, there was lots more bill issuance because they had to fund their programs in order to bail out industries, people, and they did that via bill issuance. But look at what happened after that. The bill issuance actually started to fall, and there's more issuance of the 20, 30-year bonds and the 2 to 10-year bonds. And that's a deliberate decision by the US government, the US Treasury, to lock in a low rate of funding over a long period of time. So that means that if interest rates go up, if they've borrowed for 30 years, they only pay that coupon for the next 30 years. They don't care if interest rates go up because they've issued bonds at a low rate of interest. Those rates of interest stay fixed for those bonds for their entire lifetime. So there's a deliberate attempt by the US Treasury to issue less of the short-term debt. So there's a shortage of these bills. And in fact, you can see that the yield on these money market funds is now very close to zero because, money market funds only invest in very safe short-term paper. And so reverse repo is a way for these money market funds to get T-bills. They can, if the US government isn't issuing more of them, then what they can do is take money, they can sell something, take that money and give it to the Fed, and in return the Fed will give them its massive stockpile of US Treasuries, or T-bills in particular. So reverse repo, probably the demand for reverse repo is due to that T-bill shortage. So anyway, that was what the video was about, and it looks like that's pretty much the same as it was. The dynamics there haven't changed. The US Treasury's still got a shortage of issuance of bills because they still want to lock in a low rate of funding, and at the same time the Fed is having to fill the gap because it's got a big stockpile of treasuries, some of which are T-bills. So that's the way I see it, at least. So yeah, I think that dynamic is still very much in play. Yeah, so that's the cause of it. And will the dynamic change? Probably not. As if yields stay low, if the issuance of T-bills stays low, then this thing will just carry on. And the Fed doesn't think it's a big deal. Just listen to what Jerome Powell says in the monetary policy meetings. He says, yeah, if they need it, we'll give it to them. And they'll probably give as much as they need. So not something to panic about. I mean, there was some really dodgy commentary on YouTube talking about hedge funds and how hedge funds are creating this reverse repo spike. But that's just, I think it's nonsense. But there we go. Right, so back to the questions on YouTube.
He put
there's a rejoinder.
$5 thing.
Oh, right, and Kieran gave us another $5. Thank you very much. That was from Kieran, was it?
Yeah, and says, does it prove?
Does it prove QE is no longer working, as it's all coming straight back to the Fed? Well, it actually doesn't show that at all. I'd separate the two issues. One of them is demand for T-bills, and the other one is whether, so QE, the purpose of QE is to keep lending going and to keep the monetary policy accommodative for the Fed. And if you look at any measure of lending in the US at the moment, like the Senior Loan Officers Survey, you'll see that there are very easy lending standards. So if you're a company that needs capital today, you'll get it. And banks are not tightening up on their credit standards. In fact, they're easing credit standards. So it's very clear that credit conditions are easy and monetary policy is kind of working from the point of view of the Fed. And there's not too much bank risk because bank balance sheets are not too leveraged. That's always the worry of the Fed. And it's made very sure that this time round, bank balance sheets aren't too stretched. So there's lots of equity which absorbs losses from the banks. So even if there is an equity market sell-off or even a domestic sell-off, so if housing suddenly went into reverse, banks could weather it in the US this time because the Fed's prepared for that crisis. So, the Fed's kind of quite kind of sanguine about reverse repo for that reason. But does it show that QE is not working? No, I don't think it does. But what QE does, unfortunately, is it creates greater inequality. That's almost certainly true. And it inflates asset prices. And the Fed is also aware of that. So, will the Fed pop the bubbles? Probably not. They're much more focused on their dual mandate, which is getting inflation back up to 2%, back down to 2% currently, and full employment. And remember that still, we've got 6 million people out of work in the US that weren't out of work last February. So it's very clear that their job's not finished in terms of interest rates. Okay, next question from Leonard von Niebelschutz. Nice to hear from you again, Leonard.
Addendum on this. There we go.
Oh, okay. And Leonard says, good evening all. I modified my portfolio to hold an anti-cyclical bond component of 20%. Consists of 50-50 LIX 0XL LIX 0VE. Good for this purpose, thanks. So this is a Luxembourg Euro government inflation-linked bond. Okay, so let's have a quick look at that one. So let's have a look at that. I'll just Google that, just so we can have a look at it. And your question is... Okay, so let's have a look at it. I'm a private investor. Oh, Lixor's website, it's really annoying. Here we go. Okay, now I'll share my screen so you can see this. And then we'll... Here we go. So this is one of the bonds he bought. So this is an inflation-linked government bond. If we look at the fact sheets, it'll give us a bit more juice on the fund. Now, it's inflation-linked, so the way these inflation-linked bonds work is, let's say we've got two bonds which are issued. One is inflation-linked, the other one is not inflation-linked. It's just a normal government bond. The normal government bond will carry will carry a higher interest rate, so you get a bigger income with the normal government bond, whereas the inflation-linked one is issued with a lower coupon, because the government issues them such that it thinks it can get cheaper funding, because it thinks it can control inflation, because it's very good at managing the economy, and it gives a lower coupon to investors as a result. Investors, on the other hand, don't trust the government usually, so they buy inflation-linked bonds, and then the principal that's repaid to them at maturity of the inflation-linked bond will be linked to the rate of inflation over the life of the bond. And the coupon payments, the interest payments, are linked to inflation. So that's why they're a really good inflation hedge. But in order for them to be worthwhile and to make up for the initial low income, inflation has to average more than the break-even rate of inflation in order for them to be worth more than a normal government bond. So I don't know what the break-even inflation is for this government bond fund. I wonder if it'll tell us. I doubt it will. But what we'd have to find was the Eurozone. Firstly, we'd look up the composition of the fund. So it looks like it's got a heavy UK. So this is a UK government inflation-linked bond. So now we can look up the break-even rate. And I've done that at the Bank of England's website. And for 10-year bonds, the break-even rate is over 3%. So what you're betting is that this inflation is going to be greater than 3% in the UK over the next 10, 12 years. In other words, the Bank of England will completely fail in its mandate to keep inflation at 2%, and it'll do so for a decade. Now, personally, I think that's very unlikely. So what you've done is you've taken a punt on failure of the Bank of England. The other component of the drivers of the fund would be what happens to the yield curve in the UK. Now, if equity markets fall, usually what happens is that yields also fall and the prices of government bonds go up, including inflation-linked bonds. And usually UK inflation-linked bonds have very long duration. So hopefully it's got the duration of this fund here somewhere. I can't see it. It should do, but it doesn't. I suspect it's around 20 years. UK inflation-linked bonds have very long duration. So this thing will gain a lot if equity markets fall. So to answer your question, yes, this will hedge you for an equity market fall. It'll also underperform if inflation's not above break even over the next 20 years, but you may not keep it that long. So those are the two attributes of the fund. The other attribute is that if interest rates rise, so if interest rates due to growth being priced in as being higher, then this thing will lose a lot of value because it's very long duration and real interest rates are linked to the rate of GDP growth. So if the UK surprises us with very good growth, this thing will suffer. Or if interest rates go up in the US a lot or elsewhere in the world a lot, the UK will be dragged up with them. And this thing will lose a lot of money. So just be aware that you're not hedged against growth being higher or interest rates rising generally, real interest rates. This thing could lose a lot of money that way. And it will also be very volatile because it's got a very long duration. So, that's all I'd say about this one. Is it anti-cyclical? Yeah, because it moves in the opposite way to equity, which is cyclical. And if there's a poor economic news story, so if the UK economy hits the rails, then this thing will benefit because as long as there's not deflation. The other thing to be wary of is if there is deflation, UK inflation-linked bonds don't have a floor. So you can actually get less than the initial principal back from the bond if it's a UK inflation-linked bond. Whereas US inflation-linked bonds do come with a floor. So if you lend $100 to Uncle Sam with an inflation-linked bond, you'll always get $100 back, even if there's a deflationary period. In the UK, however, if you lend £100 to the UK government with an inflation-linked bond, you may get less than 100 back if there's deflation over the life of the bond. So just be aware that that floor protection is just not there for UK linkers, and that's a risk. But that's my tuppence on your question. So let me just switch back to me. There we go. Good. And back to the questions. So you say your plan is to use this in crashy times to load up equity. So if the MSCI World Index falls 20%, use half. If 40% from all-time high, use the rest. Yeah, that would work. Personally, I've used govies for that, just normal govies, but you're also taking a bet on inflation. And you say you'll sell the bonds that fell less to still have them in a 50-50 ratio. Maybe kind of a bigger question. Thank you for all your work, Ramin. My pleasure. Thank you, Leonard. Brilliant question. And we'll go back to everybody else's questions. Good. So remember, you can always like us. You can always subscribe to our channel, and you can also do Power Hour with me. So if you want a one-to-one with me like this, but it's just the two of us, then I can also do a Power Hour. And if you want to book that, just go to PensionCraft.com/Power Hour, and you'll see how to do that. And usually people use me to bounce ideas off. I don't tell them what to do, but they show me their portfolio and we discuss the risks and potential returns of various investments. And usually it's interesting because a portfolio may not be in line with their views. They own stuff which have just accreted over time, and it may be that's inconsistent with their views. So when I read back to them what the portfolio tells me about their views, they often say, no, that's not what I think at all. So that might be a useful thing for you. Or, they just might be things which you haven't thought of. Or they have thought of everything and they just want me to confirm that the portfolio is a good one. And I sometimes have that too. So really, there's a very broad range of questions people ask me. And sometimes they just say, look, there's this fund I don't understand. Could you explain how it works? And I've actually had some financial advisors do that. And, I'm happy to do that because I like to help. So anyway, yeah, Power Hour if you like. And of course, we've got the membership. So patreon.com/PensionCraft if you want to join our membership. And that way, We've got lots of videos which only members get access to, and you also get access to Slack, so you can talk to me and other members of the community, which is now collectively much better at investing than I am, and also knows a lot more. Okay, so back to the questions. Here we go. Lawrence Snow. I've got some Snows in my family, strangely enough, a few generations back. If you want to answer a question, what's your opinion on FIRE, financial independence, retire early? And the Trinity study is investing everything into a Vanguard FTSE All World UCITS ETF wise. Well, firstly, I think the Vanguard FTSE All World, it's a huge fund, and I think the risk of Vanguard going bankrupt is pretty low. Even if it did happen, it wouldn't matter, because there are very strict rules for UK fund managers, such that they have to keep their money separate from client money, and all that would happen probably is some other fund manager would step in to manage the fund, or the assets of the fund would be sold and I'd just get my money back. So I don't think there's a huge risk by having a large investment in one fund. I do speak to some people who are very paranoid, I think, who split their investments amongst multiple platforms. So, they'll have a global equity tracker with one fund manager, and then on another platform they'll have the identical fund but with another fund manager, so that they're splitting their risk that way. But I just think that's a very minimal risk in the UK, which is so heavily regulated, and with companies like Vanguard, I just wouldn't worry about that. There are much bigger risks, market risks and behavioural risks, than counterparty risk, I think. But your other question, I don't know what the Trinity study is. If you tell me, I might have an opinion on it, but I'm not aware of what that is. The FIRE movement, yeah. I mean, if you want to retire early, then sure. And in fact, one of our relatives, I think it's Laura's niece, is into the FIRE movement. So I'm certainly aware of it. And we did a video about FIRE and also how to construct a portfolio, which is kind of geared up for FIRE. So if you want to have a look at that, we certainly have talked about it. But I mean, personally, I'm not sure I'd want to retire. If I'm still able to work, I really like what I do now, which is a luxury. I realize that's not true for everyone, and work is unpleasant. But, I think work keeps you active and it gives you a sense of self-worth. If you've got an independent sense of self-worth and things you want to pursue outside work, then I think FIRE makes sense. But work isn't just about money. I think that's very clear. So if you do kind of want to have more time to develop other skills or move on into another role or another career, then FIRE is a good way to achieve that. I think what some people might get wrong is the level of return which they can achieve through investing. And I think particularly millennials, based on some surveys that I've seen, have unrealistic expectations of what equity returns will be in future. Really what you should be looking at realistically is 6% equity return over the long term would be a reasonable assumption. And maybe 5% above inflation, 7-8% above nominal, when you don't adjust for inflation. But if you're expecting 15% or 10-15% returns for the next 20 years, that's probably unrealistic. And you probably will have to take too much risk. And if you take too much leverage, you could get wiped out. So just be aware of taking too much risk. And your best bet's probably to invest as much as you can by earning more now, as soon as you can. So what really makes me happy is when I speak to young people who have large salaries, don't spend too much, and know about investing, because I think they have the best chance of FIRE. But I think Yeah, that's what worries me about FIRE. It's just the unrealistic expectations for return, or when you don't achieve them, dialing up the leverage, and that way, or taking too much risk, and that way you could actually hurt your wealth and push away financial independence in terms of being achievable. So, I those are my worries about FIRE. Jun Zhang says, what about European stocks and value investment? Yeah, I mean, Europe has actually done very well recently. If you actually compare the US and Europe, it hasn't for a long time. I still remember when I was a strategist being on Bloomberg interviewed saying, oh yeah, we're bullish on Europe. But of course it never happened. Not while I was a strategist. That was until about 2016. But between 2012 and 2016, everybody was saying, oh, the US is doing well, Europe will catch up. But it never did. But now finally, Europe is catching up. And yeah, returns have been good and probably will continue to be good until something happens. And that's partly due to earnings growth. So it is fundamentally justified. Valuations aren't as high in Europe as they are in the US, which makes it attractive. But for a long time, people were saying the catalysts were there, but it never happened. So at least it's nice to see it is now. So yeah, I think Europe is interesting. And it's about 10% of global equity. So indirectly, I'm going to have some exposure. Okay, value. Yeah, well, value investing, obviously, at the moment, still not really working. We had a little bit of a jump in value at the beginning of this year, but then it fizzled out again. So everyone was saying, oh, this is it, the end of the 15-year drawdown. But no, it's not. So, we're still hoping it's going to turn around. It's funny, I spoke to Jim O'Shaughnessy, who said people never leave money on the table. So if stocks are cheap, you'd have thought people would step in and buy them, but it just doesn't seem to happen. Growth still seems to be winning in 2021. Of course, that won't always be true. It never is that one thing will always outperform. But certainly it's disappointing that it didn't happen in 2021. Would I invest in value? Probably not. So have a look at that factor video. I think you'll find that interesting. Probably something like quality would be better suited to my temperament, or maybe a bit of momentum, although that's a bit crashy for me. Okay, next question is, do we have any other? No others. Okay, so we'll ask another one. Do you have any children? Uma Hakim says, yes, I have 2 children who are now pretty much grown up. They're going to university this year. If so, what is your inheritance plan for them? JSIP, etc. Well, I didn't create a JSIP for them. They did have ISAs, which their parents contributed to, their grandparents contributed to, as did myself and my ex-wife. But now they're 18, obviously, I suspect they're just going to take the money and spend it. They don't have junior SIPs. Now, if I'd have known about junior SIPs when they were young, I probably would have maxed out their junior SIPs. But unfortunately for them, I didn't. If you're not familiar with junior SIPs, it's a kind of savings product where you can put, I think, up to £4,000 a year into them, something like 3,600, something like that. And obviously, the kids can't touch it until they retire. So if they're 5 years old, that's not going to be for another 50 years. So they get incredible compounding over that period. And if they just leave it in equity, you don't have to put many years in. I estimate it would be about 9-10 years of contributions, maybe 11 or 12. But if you put those £3,600 payments every year into their JSIP every year for about 12 years, you can almost guarantee that they'll have about £1 million in inflation-adjusted terms when they retire. So effectively, you can create their pension for when they retire. So that's FIRE in practice. And so you can build FIRE for your kids, but only once they reach retirement age. Some people don't like that. They think children should save for their own retirement, but some people do like that. I think I probably would have done, if I'd have known about it. but I didn't. In fact, I learned more about investing after I left the investment banking world than I knew when I was there, which is odd. Another question. So we've got 5 minutes left and lots of questions. So Lawrence, interesting. Lawrence came back. He said, he says, maybe we're relatives. I'd be honoured if that was, that's very kind of you. I'd be honoured if that were the case. It was C.P. Snow, the scientist. So I was very excited. I was related to the Snows. It was the Snow family, which were based in Leicester, I believe, that I'm related to. And Lawrence agrees that he doesn't want to retire, even though he might be able to. But he's also not currently working on a job I'm super passionate about. Yeah, I mean, if you're not passionate about work, why not? Why not retire if you can? And Uma says he's working out on his own inheritance plan. Yeah, so it's very, very tax efficient if you do the junior SIPs, because obviously there's no inheritance tax issue because you're investing when the kids are tiny. Okay, and oh, here we go. So there's a question from Ben M, who says, is the FTSE Global All Cap a reasonable investment for someone that wants a decent US exposure but also some diversity? Yeah, so the FTSE Global All Cap is heavily invested in the US. Let me just show you the kind of allocation for the fund. And I can share my screen so you can see this on Vanguard's website. And there we go. So this is the FTSE Global All Cap, if you're not familiar with it. We can look at the portfolio data. So it's got 7,000 stocks in it. North America makes up 61% of the fund. So to answer your question, yes, it has a lot of the US in it. It has 17% Europe. Pacific is 11, EM is 10, and then a tiny bit of other stuff. So the US and Japan are by far the biggest. The UK market cap is tiny, so 4%, which is roughly the size of China, although obviously China's going to overtake the UK in the years ahead, as we'd expect, and a kind of smattering of Europe. So that's what you get exposure to. The US obviously is so big because it's been successful, and US companies have grown their earnings much more successfully than the rest of the world, which is why they're valued at such high levels. So yes, to answer your question, it gives you US exposure and it is diversified. You might not like the concentration in the US, but yeah, that's what you get with that fund. How are we doing for time? We've got 2 minutes.
Well, Gary's got a question.
Oh, we've got a question from Gary. Off to Gary. Right, Gary. Will Powell be reappointed? Good question. I hope so. I think he's been pretty good as a Fed governor. He's not exciting. Okay, let's be honest. If you watch one of the Fed, if you watch one of the monetary policy press conferences, you're not kind of fired up at the end of it. But that's not what you want from a Fed governor. You want boring. You want a safe pair of hands. And he's not an economist, which I think is a bonus. He's much more market-oriented than many economists. So I think he's a safe pair of hands, and continuity is probably a good thing through this crisis. So now, obviously, the crisis isn't over for those 6 million Americans who are still out of work. So Powell is very much dedicated to ensuring that everybody gets their job back, or as many people as possible. And he's continually talking about the people who could least afford it were the ones which disproportionately took the hit from the pandemic. So he's very aware of, black unemployment, for example, which is very high in the US and remains high, and very keen on, getting that unemployment rate down, getting back to max employment. So, yeah, I think he probably will be. Interesting tweet from Claudia Salm. If you don't follow her on Twitter, you should. Who was saying that the other members of staff who will be appointed are just as important, such as the co-chair, because often the co-chair becomes the chair later on. So I think the other appointments are also important to watch. But personally, yeah, my view is Powell will get the job. So anyway, we're at 8 o'clock. Laura and I are going out for dinner with friends, so I have to keep on time. Thank you all for joining us. Please do like us, support us via by just clicking on the join button. So you can always support us directly on YouTube. You can join us on Patreon, so you can join our Patreon community for an even closer relationship with us. Or you could arrange a power hour with me if you want a one-to-one session to discuss your investments and get some investment coaching, which I would love to do. So have a great 2 weeks, everyone. We'll see you in 2 weeks' time. I hope your portfolio does really well, and let's hope that we all become financially independent and retire early. So take care, everyone, and see you in 2 weeks' time.